Here, starting off the second half of 2024, you are going to have a lot of data coming out this week, like on the economy, on the labor market, the Fed, specifically with a speech from Fed Jerome Powell that could change everything for markets. Last week was a pretty slow week in regards to economic data. We did not have much, but that changes this week. So let's start with a rundown of your economic data. As far as economic data for this upcoming week, you're going to start off with a bang coming tomorrow morning with ISM manufacturing PMIs. You're expecting a number around 50, which would be not expansionary, not contractionary. That is right at break even, if you will. Last month was at 48.7. So preferably you want to see economic data come in good right now, because the big fear is, are we heading into a recession? That's really what you want to be watching out for. A lot of secondary data will be coming out as well, along with just the headline number. ISM manufacturing employment expected to come in 1 point lower than last month at 51. Construction spending month over month is expected to be positive 0.1% after being negative 0.1% last month. ISM manufacturing new orders expected to increase a little bit from 45.4 to 46, so a slight improvement there. And ISM manufacturing prices is expected to actually fall from 57.0 down to 56. So that prices component will be very important. Now on Tuesday, you will get a speech from Fed Jerome Powell at 9:30 in the morning. That will be a big deal for markets. And we just want to see, since some of the other data has come out since the last conference with Powell, has he changed his stance? Is he a little bit more, concerned about the economy? Does he want to start cutting rates sooner? We'll get a lot of new information from that speech, hopefully. Now on Tuesday, you will get the JOLTS job openings. We're expecting about 7.9 million. Last month, we were at 8.059 million. So expecting to lose about 150,000 job openings. And again, if that number comes in really low, as some data suggests it could, that will be a little problematic. Now, JOLTS job quits, you're expecting about 3.5 million as well there. So Tuesday is going to be another big day. Wednesday, you have the ADP employment change. You're expecting 100,000, which would be pretty dang low. Last month, you were at 152,000. It'll be interesting to see what Powell says, because he may already have your jobs report, which comes out on Friday. Now, ISM services PMI will come out as well on Wednesday at 10 o'clock in the morning. The big thing to really watch here is ISM services prices. You're expecting 57.8, and that would actually be a decline from last month's 58.1. So you really want to watch that one. ISM services new orders expected to be 54. ISM services employment expected to be 47, and ISM services business activity expected to be 61. And on your just headline ISM services PMI, you're expecting 53.5. Last month, you were 53.8. So you actually want to see services probably come in a little bit weaker. That may give more credence to the whole economy's not running too hot in services. Eventually, we will see some disinflationary pressures, more so than we have seen recently in the services component of our economy. Now, the FOMC minutes will come out at 2 p.m. as well on July 3rd. On July 4th, markets will be closed, so there's really nothing that comes out on that day as well. On Friday, we'll get the non-farm payrolls number. You're expecting 160,000 job ads following last month's 272,000 job ads. We really want to see what the revision looks like there. There's probably going to be a large revision to the downside, I would imagine. And 160,000 jobs. That's right on the historical average non-farm payrolls number, 160,000. So if you start to come in even lower, yeah, that's going to be problematic. If you come in at less than 100,000 jobs, markets might start to get a little bit fearful of that. So that's a very big data point to be watching as far as the Fed as well. The unemployment rate is expected to stay at 4%. It recently has moved up to 4%. It's been like a lockstep just increase every single non-farms number that we have gotten. The unemployment rate just continues to go higher. If that stays at 4%, that might be a little comforting to markets. But if that does go up to 4.1%, you could be in for a little bit of a problem as far as that potential recession indicator. And what tends to happen is when you go up 0.6% from the low, of the cycle, up 0.6%, is you actually start to get an exponential rise in the unemployment rate. And that has already happened. Us going from 3.4% unemployment to 4% is that 0.6% point rise. And any other time you've went into recession, you see the unemployment rate really start to rise above that threshold. So specifically with that speech from Fed Jerome Powell, the Fed has made it clear in the past that they get major data before we do, sometimes a couple of days before we do. And considering we have a new jobs report on Friday, markets are closed on Thursday, we may get a Jerome Powell that is really dovish or really hawkish based on what that Friday's non-farm payrolls number is going to look like, as well as the unemployment rate. Because if Jerome Powell already has that number and maybe it's a weak number, then Powell could come out and be a little bit more dovish, more willing to signal rate cuts coming sooner, kind of precondition the markets for what that data could look like Friday, because that's going to be the biggest data. You have your ISMs, you have your JOLTS job openings, you have all of that, and that will be important. But the markets pay attention to that hard data with the unemployment rate and your non-farms numbers more than that other data. Now, as I mentioned when we were looking over the economic calendar, when you do get that rise in unemployment, 0.6%, so going from 3.4% to 4%, historically, that's when you start to see the unemployment rate shoot higher. That is really your inflection point. And you can see that illustrated here. When the unemployment rate goes up, 0.6% is when you tend to see an exponential rise in the unemployment rate. That happened in 2007, 2001, as well as 1990. And that has just happened again. So I think Powell's speech, at least I will be paying very close attention to how he is coming off. If he's coming off more cautious about inflation, about the economy, which direction he takes that speech, it will give us a massive insight to what the data will look like on Friday and will help us to position for that, whether it's trades or the entire portfolio. Make sure to hit that subscribe button if you guys want to stay informed of what I get out of Fed Jerome Powell's speech this upcoming week and what that could mean for markets. You have also seen recently hedge funds have started dumping technology stocks at the fastest pace since at least 2016. And some of this data that comes out this week will either reaffirm we should be in those tech stocks, or potentially a broadening out of our markets could be coming, or just a full-on crash or correction could be coming. Now, Fundstrat said this on Friday, quote, "Seasonality bodes well for a quick pushback to new highs in the week ahead. Unless 5,447 is broken, it's hard to get too negative on the course of the S&P. As far as near-term technicals, even a move down to 5,400 arguably won't change things materially and create an even more favorable risk to reward for U.S. equities between now and mid-July." This is what Mark Newton said on Friday. Now, Fundstrat tends to be very bullish, but in fact, the first 2 weeks in July, the start of the second half of the year, tends to be the strongest 2-week period of any market, any time of any year. The average return in the first 2 weeks of July tends to be over 2% on average. That's better than the Santa Claus rally. That's better than the start of a new year. It's the best 2 weeks of any year, seasonally. But again, judging off of all of the data that we have for this week, keep in mind Thursday markets will be closed. I think it's going to be a very volatile week at the bare minimum. Just because historically the first 2 weeks in July tend to be the best period of any time of any year, it doesn't necessarily mean that that is going to repeat again, especially if you look at historically how well markets have done on a headline S&P basis compared to like the Russell 2000 or compared to the rest of the S&P that really hasn't done much of anything this year, that's pretty abnormal as well on a historical basis. So to sit here and say that guarantees markets are going to be strong or even guarantees markets are going to be weak, I don't think that is logical. So let me know, what is your expectation for this week ahead in the economic data? Do you think this starts a correction? This economic data, if there was going to be an event that did start the correction, it's either going to be data or it's going to be earnings. So let me know what you think could start this correction. Any specific data points that you are concerned about or excited about, let me know as well down below in the comment section. And again, I will say the average correction during an election year is over 13%, and we've only seen a 5% correction so far. So even historically speaking, we should be due for a correction, but then again, we could be due for just a broadening out of our markets as well. So let me know what you think down below in the comment section. Hit the like button as well as subscribe to the channel on your way out. You guys enjoy the rest of your day, and I will see you in the next one.